I was looking at a calendar this morning, just a standard wall calendar, and it struck me how arbitrary the whole thing is.
Hmm.
We slice our lives into these neat little boxes, weeks, months, quarters. And for, for the vast majority of the working world, specifically the salaried class, those boxes dictate survival.
It's the old industrial time clock, right?
Yes.
Stamped onto a modern world.
Exactly. You work from the 1st to 30th, you expend the energy, you create the value, and technically, logically, you earn the money every single hour you're sitting at your desk or, standing on the factory floor.
That asset is yours. It's an accrued asset on your personal balance sheet.
But because of a payroll convention established during the Industrial Revolution, mostly because accountants didn't want to run the numbers every day, you're liquidity constrained. You cannot touch that asset until an arbitrary date we call payday.
It's what economists call the liquidity gap. And in the modern economy, that gap creates an immense amount of friction. It's a complete mismatch between the flow of life, which happens daily, and the flow of cash, which happens monthly.
And that friction is expensive. I mean, it forces people into credit card debt, into predatory payday loans, or just into general financial anxiety.
Sure.
I saw a stat recently that said something like 50% of employees report personal finance as their #1 stressor.
I believe it.
Not their health, not their marriage, but the gap between the 20th of the month and the 1st.
Which makes perfect sense. If your car breaks down on the 24th, the mechanic doesn't care that you get paid on the 1st. The world doesn't operate on a monthly schedule.
Precisely. And today, for this deep dive, we're looking at a company that is essentially trying to delete that calendar. We're looking at a firm that is betting the future of finance is payday on demand.
And doing so with profit margins that, quite frankly, look like a typo when you first see them on a balance sheet.
Right.
We are talking about numbers that don't usually exist in the lending world.
We are talking about Emerald Finance Limited. Now, before you tune out because you hear Finance Limited and think boring bank,
Yeah.
let me stop you. This is not a story about a bank.
Oh?
This is a story about a Chandigarh-based micro-cap company that has figured out a way to arbitrage the difference between the cost of waiting and the cost of technology.
And they are sitting right at the intersection of 3 massive tectonic shifts in the Indian economy.
Okay.
You've got the formalization of the workforce, the explosion of digital payments via UPI, and the desperate hunger for credit in the MSME sector. It's a perfect storm.
Our mission today is to really tear this business model apart. We have the annual reports, we have the Reserve Bank of India guidelines, and we have the raw financial data from FY25 and FY26. We need to figure out, is Emerald Finance a revolutionary fintech disguised as a lender?
Or is it a regulatory ticking time bomb that's going to get crushed by the big banks?
That is the multi-million rupee question.
Yeah.
Because when you see a company growing profits by 73% in a year, you have to ask.
Is this sustainable alpha, or is it a trap?
Let's get into it. So let's start with the entity itself, Emerald Finance Limited. If I pull up their listing on the Bombay Stock Exchange, they are classified as a non-banking financial company, an NBFC. For anyone who isn't deep in this world, let's clarify what that actually means in the Indian context versus a standard bank like HDFC or SBI.
Sure. The simplest way to think about it is that a bank is a deposit-taking institution. You give a bank your money, they hold it in a savings account, they pay you a tiny bit of interest, and then they lend it out.
Okay, so they have access to cheap capital, our savings.
Exactly. That's their core advantage, cheap capital.
Yeah.
An NBFC, generally speaking, and specifically in Emerald's case, cannot take demand deposits from the public. They can't open a savings account for you.
So where do they get their money to lend?
They have to raise capital from other sources. So borrowing from banks, issuing bonds, or using their own equity reserves.
Which means their cost of funds, the price they pay to get money to lend, is usually higher than a bank's.
Exactly. And usually that puts NBFCs at a massive disadvantage. They are buying money at wholesale prices and selling it at retail. It's a tough game.
But Emerald is different.
Emerald is a hybrid. It's part traditional lender dealing with retail and small businesses, but it's increasingly morphing into a platform business.
A platform business.
Mhm.
And that pivot is centered around their STAR product, which is this concept of early wage access, or EWA.
That's the one.
We need to break down the mechanics of this because it's not a loan in the traditional sense, is it? It's not like walking into a bank and asking for money.
No, and that distinction is absolutely critical, especially when we get to the regulatory risks later.
Okay.
Think about the user journey. Let's say you are an employee at a mid-sized manufacturing firm in Louisiana. It's the 18th of the month. You've worked 18 days.
In a traditional setup, I have 0 rupees in my pocket from this month's work.
Correct. But with this product, your employer has integrated their payroll system with the Emerald app. It's a B2B2C model. They sell to the business to get to the consumer.
Okay, so I open the app on my phone. What do I see?
You open the app and it doesn't show you a loan offer. This is the key psychological trick. It shows you a balance. It says accrued salary, 25,000 rupees. It's showing you the money you have already earned but just haven't been paid yet.
That is a huge shift. Psychologically, it's not borrowing, it's accessing. It feels like my money.
It is your money. You're just getting it sooner. So you tap a button to withdraw, say, 10,000 rupees because you have an unexpected medical bill.
And the money just appears.
The money hits your bank account instantly via UPI or IMPS. It's seamless.
Okay, stop there. Where'd that money come from? Did the employer send it? Is it an advance from my boss?
No, and that's crucial for the employer. The employer's cash flow isn't touched at all. Emerald fronted the money. They use their own balance sheet to bridge that gap between the 18th and the 1st.
Okay, so Emerald is out 10,000 rupees. How do they get paid back? Do I have to remember to send them a check on payday? Because that sounds like a point of failure.
And that is the magic of the model. It's why the margins are so incredibly high. There is no chasing involved. There are no collection agents.
How?
Because they integrated with the employer's payroll system. On the 1st of the month, the employer's software automatically deducts that 10,000 rupees from your total paycheck and wires it directly to Emerald. The rest of your salary hits your account as usual.
So the borrower, the employee, never even touches the repayment flow.
Never. It's intercepted at the source.
That fundamentally changes the risk profile, doesn't it? I mean, completely.
It collapses the risk profile. In normal unsecured lending, like a personal loan or a credit card, the biggest risk is what they call intent to pay.
Right. The borrower gets the money and then just decides, you know what, I'm not paying this back.
Exactly. Here, the borrower's intent is irrelevant. The repayment is a systemic automated deduction.
Which explains why, in their investor presentations for the EWA segment, they report 0 NPAs, non-performing assets. I mean, that is a unicorn statistic in lending. 0 defaults. It sounds impossible.
It's practically 0. The only way Emerald loses money in this scenario is if the employer itself goes bankrupt in that 2-week window between the advance and payday.
Or, I guess, if the employee quits and flees the country before payday.
Right. But those are extreme edge cases. It's a completely different risk. It turns a consumer credit risk problem into a simple operational liquidity problem and a very short-term corporate credit risk.
So let's talk about the revenue, the part that makes this a business. If I'm the employee, what am I paying for this privilege? Is there an interest rate?
They are very careful not to frame it as interest.
Why?
For regulatory reasons. They frame it as a transaction fee or a processing fee. It's typically a flat fee per withdrawal, often around 2% to 3% of the amount you take out.
Okay, so if I take out 10,000 rupees, I pay maybe 200 or 300 rupees.
Right.
That feels cheap. It feels like the cost of a couple of coffees or a fast food meal. It doesn't trigger the same alarm bells as 18% interest.
Psychologically, yes, it feels negligible. It's a convenience fee. But, and here's where we need to put on our financial analyst hats, if you annualize that fee, the numbers are absolutely staggering.
Okay, let's do the math, because I suspect this is where the 50% profit margin comes from.
This is exactly where it comes from. If you pay a 2% fee for access to capital for, let's be generous and say 15 days or half a month, that's equivalent to a 4% monthly rate. You multiply that by 12 months. You are effectively looking at an APR, an annual percentage rate, of roughly 48%.
48 to 52%.
Yeah.
That's high yield territory. That's higher than most credit cards.
It is massive yield. But because it's presented as a small one-time fee, the user doesn't perceive it that way. And for Emerald, the duration is incredibly short. Money out, money back in 15 days.
The velocity of money.
The velocity of money is incredibly high. They can lend that same 10,000 rupees out, get it back, lend it to someone else, get it back. They can turn their capital over 12, maybe even 24 times a year. A traditional lender might turn their capital over once.
So for the user, it's a small convenience fee. For the lender, it's a high-velocity, high-yield, near-zero risk arbitrage engine.
You've nailed it. And look at it from the employer's perspective. Why do they sign up for this?
I was going to ask, what's in it for them?
It costs them nothing. Zero. Emerald puts up all the capital. The employer just integrates the software, which is usually a simple API call to their existing HR management system.
And in return,
They get a powerful employee benefit. It boosts retention, it boosts productivity because people aren't sitting at their desks stressed about an overdue bill. And the company doesn't have to act as a bank for its employees, which is something HR departments hate doing.
it's a win-win-win. The employee gets liquidity, the employer gets a free perk, and Emerald gets a 48% annualized return.
Assuming the regulator is okay with it, which, again, is the big asterisk we will get to.
Right. But first, we have to ground this in reality. EWA is the sexy future state. It's the headline grabber. But when we look at their FY25 and the 9-month FY26 numbers, that isn't where the bulk of the cash is coming from today, is it?
No, and this is a common misconception with these kinds of fintech pivots. You sell the market on the future story, but you fund it with the boring old school past.
And the boring past is?
Right now, nearly 48% of their revenue comes from their direct selling agent business, or DSA.
DSA. Okay, let's unpack that. This sounds less like fintech and more like hustle.
It is pure hustle, 100%. It is essentially a lead generation and processing business. Emerald acts as a connector, a middleman.
How does that work?
They have built a network of about 1,600 sub-agents. Think of these as guys on the ground in Tier 2 and Tier 3 cities, often with deep local networks. They find people who need loans, home loans, car loans, business loans.
Okay, so they're like loan brokers.
Exactly. Emerald takes those applications from their agents, packages them, does the initial vetting, and then shops them to their partners.
And the partners are the big boys. We aren't talking about small, obscure lenders here.
No, we are talking about HDFC, Kotak Mahindra, Avance Financial Services. Over 40 distinct banks and NBFCs are on their panel. Emerald aggregates all these leads and hands them over to the institution that is most likely to approve it.
And if HDFC approves the loan, Emerald gets a commission.
That's the model.
What's the spread there? Is it actually worth the effort? It sounds like a lot of paperwork.
It varies by product. A gold loan, which is very safe because it's backed by physical gold, might pay a 1.25% commission. Pretty low.
Yeah.
But an unsecured personal loan, higher risk for the bank, might pay up to 3.5% or even 4%.
And Emerald has to split that commission with the sub-agent on the ground who found the customer.
Yes, they pay out about 15 to 20% of that commission to the sub-agent. But the beauty of the DSA model, from Emerald's perspective, is that it is risk-free revenue.
Explain that. Why is it risk-free?
Because Emerald isn't lending their own money. If I connect you to HDFC for a personal loan and you default 6 months later, that is HDFC's problem. It's on their balance sheet.
Not yours.
I already cashed my commission check. Emerald takes zero credit risk in this entire vertical. It's pure fee income.
I see the strategy. It's brilliant, actually. They use the stable, risk-free cash flow from the DSA business to build their capital base, which they then deploy into the super high-margin proprietary EWA business.
It's a classic cash cow, funding a star. And they do have a third vertical direct lending where they do lend their own money for things like gold loans or MSME business loans. But looking at the management commentary, they are clearly trying to keep that asset light.
Asset light is the buzzword of the decade. Everyone wants the revenue without the heavy lifting of the assets.
They don't want a heavy balance sheet. They want to be a tech platform that facilitates transactions, not a bank that holds risk.
Okay, that makes sense. But let's look at the market they are playing in, because a great model in a vacuum is useless. Is there actually demand for this? We keep hearing about the Indian growth story, but drill down into the credit numbers for me. Is this a big enough pond for a small fish?
It's not a pond, it's an ocean. And to understand the demand, you have to understand the MSME credit gap.
MSME, micro, small, and medium enterprises.
Correct. This is the engine of India. We're talking about 63 million businesses. These are everything from your local Kirana store, the little grocery shop on the corner, to small auto parts manufacturers, to textile workshops.
The real economy. And how much credit do they need to operate and grow?
The estimates for the total addressable market, the TAM, are just mind-boggling. They range from 50 to 80 lakh crore rupees.
Trillions of rupees of demand.
Yes.
And the supply from the formal banking sector.
That's the tragedy. There is a shortfall, a credit gap of about 20 to 30 lakh crore. That's the unmet need.
That is a massive number. Why? I mean, if there is that much money to be made, why aren't SBI, ICICI, and Axis Bank flooding this zone? Banks are in the business of lending, aren't they?
They are, but they are in the business of safe lending, or rather, what they define as safe. The traditional banking algorithm is broken for the small guy.
What do you mean by algorithm?
Banks require collateral, hard assets like land, a factory building, a house. But 80 to 85% of these MSMEs are microenterprises. They operate out of rented premises. They have strong cash flow, but they don't have a property to pledge.
So they are credit invisible to a traditional bank. The computer says no because they don't fit the box. The underwriting model is based on assets, not cash flow.
Precisely. They face rejection rates of over 50%, and this is where a niche player like Emerald steps in. They are willing to look at different data points, turnover, UPI transaction velocity, payroll data, GST filings to underwrite these guys. They're building a different algorithm.
And this ties directly into the formalization theme we touched on in the intro. This is a huge government-driven shift, right?
It's the single biggest tailwind for this entire sector. The government launched the Udyam portal to get these businesses to register themselves officially.
No, they.
The numbers are incredible. Since 2020, registrations have gone up fivefold to over 63 million. These businesses are coming out of the shadows, out of the cash economy.
Why does that registration matter so much for a lender?
Because once they register, they become part of the formal economy. They get a digital identity, they can be verified. And historically, when a business moves from informal to formal, their demand for formal credit jumps by 15 to 20% annually.
Because they can finally prove they exist and show their records.
Yes, and you combine that with the India digital stack UPI specifically, and the whole game changes.
How so?
The cost of serving these customers has plummeted. 10 years ago, if you wanted to lend 20,000 rupees to a guy running a small shop in a village in Punjab, you had to send a guy on a motorbike to collect the cash and the paperwork.
The operational cost would eat the profit.
Exactly. It cost you maybe 500 rupees just to process the loan. It destroyed the margin on a small loan. It wasn't worth the gas money.
And today?
Today, with UPI and Aadhaar eKYC, the digital identity verification, the cost is virtually zero. You can acquire, vet, and disperse a loan to a customer in minutes without ever meeting them. This massive reduction in customer acquisition cost, or CAC, is what makes the unit economics of small-ticket lending viable for the first time in history.
It's a volume game now, and the tech makes the volume possible.
Correct.
And Emerald is based in Chandigarh, which is North India. Does geography play a role here, or could they be based anywhere?
I think it's actually an edge. Their main focus is on Punjab, Haryana, Delhi, NCR. This region is seeing urban MSMEs grow almost 2 times faster than some other parts of the country.
So they're in a high-growth corridor.
And you layer on the demographics. India's working population is going to peak by 2030. So you have a massive young workforce entering the formal system, needing credit, and they are completely comfortable using apps for everything. It's a perfect storm of opportunity.
Okay, so the macro picture is extremely favorable. The business model's clever. Now, I want to get aggressive on the financials because when I looked at the P&L statement you sent over, I had to double-check the formulas in my spreadsheet.
You're looking at the net profit margins.
I am. I'm looking at net profit margins of 48% to 56%. That is,
Right.
It's obscene. I mean that in a good way for them. A decent manufacturing business makes 10%. A good SaaS company makes 25, 30%. A bank, a really good one, makes maybe 15% if they're absolutely crushing it. How is Emerald keeping 50 cents of every dollar that comes in the door?
It goes right back to that asset-light concept we talked about. Think about a traditional bank. What are their biggest line items on the expense side?
Buildings, vaults, security guards, tellers, air conditioning, marketing, a huge staff.
Exactly. Physical infrastructure and people. Emerald operates with extreme efficiency. Their cost of revenue is minimal. For the EWA product, the gross margin is near 100%.
Wait, repeat that. Near 100%. How can anything be near 100%?
Think about it. What is the cost of goods sold for an EWA transaction?
There isn't one.
There isn't one. There's no credit risk cost because the employer deducts the repayment at the source, so you don't need to provision for bad debts. The only real cost is the technology cost building and maintaining the app and the API integration with the HR software.
And once that software is built?
That's operating leverage. It's beautiful. Once the platform is integrated with a company's HR system, adding the 100th employee or the 1,000th employee costs them almost nothing. It's just another entry in a database.
But the revenue from those transaction fees keeps rolling in.
So every additional dollar of revenue drops straight to the bottom line. It's a software margin profile on a finance product.
And because they aren't borrowing huge amounts of money to lend out, their interest expense is low, I assume.
Very low. Which brings us to their balance sheet. Let's talk about that debt. I see the debt-to-equity ratio here in their filings. It's hovering between 0.16 and 0.20.
Which, for an NBFC, is absurdly low.
It's almost unheard of. Most lending businesses are leverage machines. They borrow 10, 12, 15 rupees for every 1 rupee of equity they have. They live and die by the interest rate spread.
And Emerald is barely borrowing at all.
They are funding their growth almost entirely through their own internal accruals, their own profits. They're a self-funding engine.
What does that imply for the safety of the company for an investor?
It implies a fortress balance sheet. If the Reserve Bank of India raises interest rates tomorrow by a full percentage point, a highly leveraged peer gets crushed. Emerald, they don't care as much. If the bond market freezes up and credit gets tight, Emerald doesn't go bankrupt. They aren't reliant on external liquidity to keep the lights on.
But the flip side of low leverage is usually lower return on equity, or ROE. Leverage is what juices your returns. That's Finance 101.
That is the textbook rule. But Emerald is defying it, and they're defying it because their asset yields, the return they get on the money they deploy, are so incredibly high.
Back to that 48% annualized yield on EWA.
Exactly. When you are earning 48% on your capital, you don't need to leverage it 10 times to make a good return for shareholders. You can run a very conservative balance sheet and still generate massive returns on equity.
That's a fascinating dynamic. High velocity replaces high leverage.
That's the perfect way to put it. And looking at the recent sprint, the first 9 months of FY26, so from April to December 2025, the numbers validate this entire thesis.
Go on.
Income is up 42% year over year. Net profit is up 73%, hitting about 10.7 crore rupees.
In EPS, earnings per share, that jumped to over 3 rupees, right? Around 311.
Right. And management isn't shy about their ambitions. They're guiding for an EPS of 7 to 8 rupees by the end of FY27.
So they're telling the market, we are going to double the company again in about a year and a half.
That's the plan. They want to reach assets under management, or AUM, of 300 crore in the next 5 to 6 years.
Okay, expert. You've painted a picture of a perfect business. High margins, no debt, massive growth, huge market. It sounds like a slam dunk. Yeah. But I'm looking at the stock chart, and it is a disaster.
Down 46.6% in the last year.
This is the disconnect. This is what I don't get. If the story is so good, why is the market selling? Is this a value trap? What are we missing? What does the market see that we don't?
This is where we have to step away from the spreadsheet and look at the market's psychology and the structural risks. There are, I think, 3 main reasons for this brutal price crash.
Okay, hit me with number 1.
Liquidity and market cap. It's simple mechanics. Emerald is a microcap stock. The market capitalization is roughly 237 to 270 crore rupees. That is tiny.
A rounding error for the big funds.
Exactly. Institutional investors, mutual funds, foreign institutional investors, FIIs, usually have internal mandates that prevent them from buying companies this small. They literally can't buy it, even if they love the story.
So who owns the stock?
Mostly retail investors. And retail investors are fickle. They chase momentum. When the stock started correcting, maybe due to general market weakness or one bad quarter, they panic sold. And in a microcap, when a few people sell, the price creates a vacuum and drops sharply. There is no buyer of last resort, like a big mutual fund stepping in to stabilize the price.
It's illiquid, so small trades have a big impact. Okay, reason number 2.
The sustainability discount. The market does not believe the 56% margins are real.
Or at least not that they can last.
Right, they don't believe they can last. The basic law of capitalism is that excess profits attract competition. Investors are looking at this and assuming that eventually someone will come in and eat Emerald's lunch, driving those margins down to a normal 15 to 20%. They're pricing it for a mean reversion.
And reason number 3, this feels like the big one.
It is the regulator, the RBI, the Reserve Bank of India.
Okay, let's do a deep dive on the regulatory risk. Because in Indian finance, the RBI isn't just a regulator, they are the weather. They can summon a hurricane whenever they want and sink your ship. What specifically is the threat here?
The threat is classification. It's about definitions. Right now, Emerald operates in a gray area regarding EWA. Is EWA a loan, or is it a salary advance, which is a different category?
Why does that label matter so much? A loan, an advance, what's the difference?
All the difference in the world. If the RBI decides to classify EWA strictly as a loan, then all the lending norms apply. That means strict that error. Know your customer or KYC norms for every single transaction. It means credit bureau reporting for every 5,000 rupee withdrawal, which adds operational friction.
Okay, that's annoying, but maybe manageable. What's the killer?
The killer is potential interest rate caps.
Ah, if the RBI says you cannot charge more than, say, 18 or 24% APR on an unsecured loan, and Emerald is effectively charging 48%.
Their revenue gets cut by 60% overnight. The model breaks, the whole high-margin thesis evaporates.
Has the RBI signaled that this is coming? Are there warning signs?
They are watching the space very closely. In 2024 and 2025, they started pushing for formal guidelines on EWA. They are very concerned about predatory lending masquerading as tech innovation. They don't like high-cost, short-term credit products aimed at vulnerable borrowers.
And there's another risk, right? This third-party origination issue.
Yes. This relates to their partnership model. If the RBI decides that regulated entities like NBFCs cannot rely on unregulated fintech apps to source customers,
Which is their whole DSA business.
it could cripple it. Or if they ban something called FLDG, first loss default guarantee arrangements.
Explain FLDG. That sounds like jargon.
It is. In many fintech partnerships, the fintech says to the bank, hey, let me use your balance sheet to lend money. And if the customer defaults, I promise to cover the first 5% of losses. This is FLDG. It aligns incentives.
But the RBI doesn't like it.
The RBI hates it because it feels like it hides the true risk from the bank's balance sheet. If the RBI bans or strictly caps FLDG arrangements, many of Emerald's DSA partnerships could be in trouble.
So the entire asset-light partnership model is vulnerable to a single circular from the central bank.
Correct. That is the sword of Damocles hanging over the company. And smart investors know this. They are pricing in the risk that the RBI shuts the party down, and that's a big reason for the stock price decline.
Okay, let's talk about the competition. You mentioned that excess profits attract competition. Who is coming for Emerald's slice of the pie?
Everyone. But specifically, the giants. The well-capitalized fintechs, PDM, Cred, PhonePe, and the banks themselves, HDFC, ICICI, Kotak.
But Emerald has a head start, right? They have the corporate integrations. That's a moat, isn't it?
It is, but it might be a shallow one. Consider the loss leader strategy.
Okay.
Imagine HDFC Bank goes to a big corporate client, say an IT company with 10,000 employees, and says, switch your main corporate payroll account to us. In exchange, we will give all your employees early wage access for free.
Free? Why on earth would they do that? They'd lose money on every transaction.
Because HDFC doesn't care about the transaction fee. They want the the current account savings account deposits. They want the cheap capital from all those salary accounts. They can afford to lose money on the EWA feature to gain the much more valuable sticky banking relationship.
And Emerald, whose entire business model depends on that 2% transaction fee, cannot compete with free.
Exactly. You cannot win a price war against a balance sheet that is measured in trillions of rupees. If EWA becomes a commoditized feature of a payroll account rather than a standalone product, Emerald is in deep trouble.
That is a terrifying bear case. The product becomes a standard feature of every payroll software, and the standalone fee drops to zero.
That is the ultimate existential risk for this business model.
What about the economy itself? We've had a pretty good run. If we hit a recession, does this model hold up?
That's the risk of cyclicality. And it hits them in two ways. First, EWA depends on people having jobs.
Right.
If the economy slows, corporates cut staff. If people lose their jobs, the pool of users for EWA shrinks dramatically.
And the other side of their business, the MSMEs they lend to.
Small businesses are the first to suffer and the last to recover in a downturn. Their cash flows are fragile. We've seen this in Emerald's own history. Their debtor days, the average time it takes to get paid back, have been volatile.
Oh, volatile.
Ranging from a healthy 22 days to over 152 days in bad time.
152 days. That's 5 months of waiting for your money. That can create a serious cash crunch for a lender.
A huge one. Recently, it's improved to around 36 to 45 days, which is good. But if you see that number spike above 68 or 70 days in their quarterly reports, that's a major warning signal.
And we actually saw a specific incident recently that proves the risk isn't just theoretical, right?
Yes. In Q3 of FY26, it shows that even the zero-risk EWA model has a flaw.
What happened?
A single corporate client ran into financial trouble. And suddenly, Emerald had an NPA spike of 26 lakhs on their books from that one account.
Which isn't a huge amount of money in the grand scheme.
No, and they did recover 17 lakhs of it later,
Wow.
but it broke the zero NPA narrative.
It proved that even if the employee is honest and the system works perfectly, if the employer goes bust or messes up the payroll, Emerald is left holding the bag.
Exactly. At the end of the day, Emerald is taking on short-term corporate credit risk. If the company they partner with goes bust, that deduction mechanism fails and their money is gone.
So, high reward, but definitely not risk-free.
Mm.
Let's look at the people driving the bus, because in a microcap like this, you are betting on the jockey more than the horse. Who is running this show?
The key figure is Sanjay Agarwal, the managing director. He's been there for over 11 years, so he has seen the company evolve.
And does he have skin in the game? What's the promoter holding?
He does. He holds about 32% ownership of the company.
That is significant. I always like seeing that. It means if the stock goes down, he loses real money too. His interests are aligned with minority shareholders.
Usually aligns incentives, yes. And his operational style seems to be quite conservative, which is what you want in a lender.
How so?
He's been prioritizing credit quality over just blind growth. For example, in a recent investor call, he mentioned they had cut their corporate onboarding target. They had planned to sign up 250 new corporates for EWA, but he slashed that number.
That's rare. Usually CEOs just want to yell, growth, growth, growth at the top of their lungs.
It shows discipline. He said they didn't like the credit profile of the companies they were meeting, so they walked away. He chose not to grow rather than take on bad risks. That is exactly what you want to hear from the person managing your capital.
And he's reinvesting profits rather than paying out huge dividends?
Yes, he's building the war chest, strengthening the balance sheet for future growth or a potential downturn. However, there are some black box elements here that we need to acknowledge.
What do you mean by black box?
Well, it's a small company. There is some family concentration on the board of directors. And compared to a Tata or a Reliance, the level of transparency and institutional coverage just isn't there.
So it's harder to get a clear picture.
Exactly. We don't have a detailed, granular track record of how they handled the last major crisis, say, during the initial COVID lockdowns. We know they survived, but the detailed reporting isn't as robust as with a large cap.
So you are betting on the jockey, but you haven't seen him ride in a really, really bad storm yet.
That's a very fair assessment. They are, to some extent, untested in a severe, prolonged recession.
Okay, let's look forward. Section 7, where does Emerald go from here? They have the EWA product, they have the DSA cash cow. What's the next frontier for growth?
The first and most obvious vector is just doing more of the same. Deeper penetration. They currently have about 145 corporate partners for EWA.
That seems incredibly small given how many millions of companies there are in India.
It is tiny. The runway is massive. If they can get to 1,000 or 5,000 corporates, the revenue just multiplies without much change to the core business. But the more interesting strategic play is the ecosystem expansion.
The super app thesis. Every fintech wants to be a super app.
Exactly. Once you have an employee checking your app every day or every week to see their accrued salary, you have captured their attention. You have the eyeballs, as they say. You have their trust.
So you start cross-selling.
Precisely. Hey, you checked your salary, by the way. Do you need to buy insurance? Do you need to pay your electricity bill through our app? Do you need a credit builder card to improve your CIBIL score? Emerald can become the financial operating system for that employee.
And then there is the data play. The digital shift, as you called it.
This is the holy grail for any lender. Underwriting is all about information asymmetry. The lender knows less than the borrower.
Right.
But Emerald flips that. They know exactly how much you earn, to the penny. They know exactly when you get paid. If you use their bill pay feature, they know your spending habits. That data is gold.
Because it allows them to offer you a personal loan or a car loan with much better pricing than a traditional bank that knows nothing about you other than a credit score.
Data-driven underwriting is the future of this company. They can use the EWA relationship to identify the good borrowers who might look bad on paper to a traditional lender and then offer them other credit products from their own book.
So let's try to summarize this entire deep dive with a clear bull case versus a bear case.
Okay, the bull case. Emerald builds a defensible niche monopoly on salary on demand. They stay small and nimble enough to fly below the radar of the big banks. They successfully navigate the RBI regulations by being compliant and conservative, and they ride the massive wave of Indian formalization to become a multi-billion rupee company. The margins might compress a bit from 56%, but they remain extremely high due to tech efficiency.
And the bear case, the nightmare scenario.
The RBI wakes up one morning and issues a circular that caps fees or reclassifies EWA in a way that kills the unit economics. Or HDFC and Paytm decide this is a market they want, and they crush Emerald with free capital and zero-fee products. The stock goes to zero or stagnates as a zombie company.
It really is binary, isn't it? It's either a rocket ship or it hits a glass ceiling and falls.
That's the nature of small-cap finance, especially when a business model is built on regulatory ambiguity. You are buying a lottery ticket attached to a very smart business model.
As we wrap this up, I'm thinking about the bigger picture here. We call this a finance story, but it's really a work story. To me, Emerald is basically a pick-and-shovel play on the formalization of the Indian workforce.
That's a great way to put it. They are betting that India is moving from a world of cash and chaos to a world of digital and organized payrolls. And by moving away from risky direct lending toward this fee-based service model, they are trying to insulate themselves from the bad debts that usually kill lenders in a downturn. It's a smart strategic shift.
But I want to leave our listeners with a final, more provocative thought. We spend a lot of time talking about debt. And usually we're taught that debt is bad. Don't borrow against your future.
Right. The conventional wisdom is to live within your means.
But is early wage access actually debt? Or is it just an asset liquidity?
That is the philosophical question at the heart of this, isn't it? If I have already done the work, the money is mine. Accessing it isn't really borrowing. It's just claiming what I already own a few days early.
Exactly. If Emerald and companies like it succeed, they aren't just a lender. They are fundamentally changing the definition of payday.
And if they do that, consider the second-order effect. In a world where you can get paid daily, every single day, does the concept of a monthly budget become obsolete?
Oh, wow. I hadn't thought of that.
Think about it. All of our financial discipline, for better or worse, has always been anchored to that 30-day cycle. You get the lump sum, you ration it out over 4 weeks. If the money just drips into your account daily like water from a tap, do we lose the ability to plan for large expenses? Do we become a society of instant gratification spenders?
Or does it actually solve a huge piece of poverty? Because people aren't forced to go to predatory loan sharks to cover a simple 3-day gap until their salary comes in.
It could be both. It could solve the short-term liquidity crisis, but maybe create a long-term behavioral crisis.
That is something to chew on. Is the death of the monthly paycheck also the death of the monthly budget?
I think we are all going to find out over the next decade.
Well, on that note, we encourage you to look deeper. Don't just look at the headlines of the big banks. Look into the unsexy corners of the financial market. The plumbing of payroll, the back end of lending. That is often where the real innovations and the real profits are hiding.
Absolutely. Always read the fine print.
Thanks for listening to The Deep Dive. We'll see you next time.